All right, it has been a long time since we've done one of these, Robert.
Quite along. Been a little busy.
And we have been busy. We've been busy this summer actually doing a lot of research into our portfolios.
That's right, and that's why we're recording this custom video for you, our clients, and whoever else cares, but probably no one else.
That's fair. Well, so we did a lot of heavy research. What's really fun is we decided to do an investment summit because we realize that's a huge part of what we do is making sure that the portfolios are doing exactly what we want them to do. So we did a deep dive. I would say I did a medium dive. You did the deep dive. And we had great conversation. But I'd love for you to share a little bit about the heavy research and kind of some of the things we did.
Absolutely. So at Cardinal Hill, we have a not that novel of an investing philosophy, but one of the things that we really try to do is take ongoing analysis and due diligence of our model portfolios very seriously. So we have a long-term view of the economy. We don't like to market time, but what we found is the public market indexes are a moving target, or our fund portfolio managers change how much cash they're holding. There's all these moving pieces. So even though every month we're doing ongoing due diligence of each component of the portfolio, like actively managed bonds or international equities, we felt like it was a good idea to just analyze the entire portfolio as a sum. It was a massive project and it was really fruitful. So some of the things that we did was we met usually multiple times with every single fund manager, calls people all over the world and said, hey, we need to not only see how you're doing, but relative to a variety of benchmarks. Some of them didn't like it very much because we asked them to pull custom data. We also said, show us your underlying information about how these bonds are performing. And they're telling us things like, no financial advisor's ever asked for this before. And we said, that's great. You're gonna give it to us or you're fired. And most of them were happy to comply, and some of them are still trying to get compliance approval. And so it's been a really fun process to kind of stretch the limits of what information we can get. But at the end of the day, we now have a really deep understanding of not only what's going on in our portfolios, but also the broader market. I think one of the most fascinating findings for me was understanding on the bond side, the aggregate bond index is becoming more and more concentrated with government debt. As the government is printing more treasuries, that is percentage-wise making up a bigger component of this index, and many investors, such as us, don't really love a greater portion of our clients' money going towards treasuries. Not that they're bad, just the role they play in the portfolio doesn't feel as efficient to us sometimes. So in general,
I think that hits though of the depth of which we dove into the research, because it was so important to understand exactly how that risk would play out with our investments.
Right. And so broad updates for y'all, our clients. Some of the things that we've done is look at having a greater exposure to different types of bonds. So leveraged loans is one example. Think of it as like the floating rate version of high yield corporate debt. They have very high interest rates, but may move in a different direction with high yield debt. Or looking under the hood and realizing that some equities that used to be considered growth are now kind of value. And so just rebalancing those components. No major updates in that regard, just trying to keep everything in balance, but really trying to level up our benchmarking, making sure every fund is beating the benchmark that they say they're beating truly when you look under the hood. So
if you could, Robert, provide. So we did a lot of deep research, went really deep. We came away with some findings, and we wanted to do a rebalance after that. Can you kind of just break down what that looks like for us and how we're approaching that breakdown?
Right. So some of that was, for example, in our model portfolio, let's say it was a client portfolio with 80% stocks, 20% bonds. Looking at that 20% bonds, we may have shifted some away from, just treasuries or government debt into different types of bonds. And to show you an example, with some of our retiree clients, we had been using a fund called the Vanguard Wellesley Fund. It's a popular fund. It's been around for a long time. It's kind of an all-in-one, value-oriented for equities and kind of defensive nature for bonds. But when you go back to what we were thinking about before, we didn't love how much in treasuries it was holding. And so I want to walk you through my extremely ugly whiteboard to kind of talk through some of this, pardon the nerd moment. I'm going to try to make it simple. So in general, we looked under the hood, and this particular fund was 61% bonds, 39% stocks. And then as you can see, it was 60% corporate, 20% taxable municipal bonds, and 20% treasuries. It's okay if that doesn't make sense. The point is, under the hood, these corporates behaved a lot like treasuries. We weren't super comfortable with it. And then there's different breakdowns of the types of stocks it was owning. And so when we look at unwinding this position, we're going, okay, we can't just buy some random fund. We had to split these allocations precisely among the different holdings, but we felt good about that because we really like our corporate bond funds, for example. We think that they have better health characteristics. Again, back to that fund-to-fund comparison. And so I'm not going to walk through all of this, but we're
all thankful for that. Just so you know, Robert.
We're trying to be sensitive to, how that impacts clients' taxes and, which accounts it's easier to implement. And then, just really incorporating that in with some of the other findings that we're finding in the market. So taking one position, this time we found that we really needed to split it into multiple other positions to really balance out the potential risk-adjusted returns. So anyway, that's just a little bit more of kind of how that worked.
Yeah, last thing that I really found fascinating, and we'll give a little shout out to Cullen, who helped us as an intern. This summer, awesome. We did a lot of research into the alternative investment space. It's referred to a lot in our world as alts. Mm-hmm. So if you hear us say alts, that's what we're talking about. But the alternative investment space was fascinating. I mean, I think that was probably the most enjoyable part of this whole research that we did as far as eye-opening and enlightening.
Right. It's really interesting because in a number of businesses' perspective, the U.S. economy and global economy is shifting to where more and more companies are private. They're not even in the publicly traded markets. And so when you want exposure to the whole world, which is kind of what we're going after, it's becoming more and more important to us to really deeply analyze and understand it. There's some major data issues with the alternative investment space. We're concerned about biased data and underrepresented findings. So, for example, all the cool venture capital firms show out their amazing returns, 20 or 30% a year, but we don't have the data on the funds that failed. And so that's really concerning. We did a deep dive into all that, looked at a lot of academic research, really interesting stuff. We continue to evolve on that. We're not ready to implement any of this at broad scale, but we're excited about the potential to improve our clients' risk-adjusted returns in the future with further analysis.
So if I were to ask you, what is an alternative investment? What is it? Just give me a high level, but like with a practical example tied to it.
Sure. Sometimes the best way to say it is what is it not? Well, it's not publicly traded stocks and bonds, and you could think of it as everything else. It could be venture capital firms, private equity. It could be infrastructure, like trying to own timberland. It could be commodities, so gold and silver, palladium. There's a whole host of liquid alternatives. Some of them are really messy to use because you have liquidity concerns, like a hedge fund. You could maybe not even get your money back except for a little bit every quarter or every year. A lot of times they have massive fees, so a 2% annual fee and then 20% of any profits that the fund generates that year. So really interesting space, but has given us a lot of hesitation into it. However, the sales pitch that we're hearing from a lot of these investment companies is, wow, look at those returns, aren't they amazing? So we feel like it's our fiduciary duty to analyze this growing portion of the market, but it's, future work is still TBD, just such a big space. So it's been really fun to look into.
That has been really exciting, fun stuff. We really are thankful that you trust us with your dollars. We take it with great seriousness to be amazing stewards of what you've trusted us with. So thank you very much. From Cardinal Hill, this is just a little peek under the hood, I suppose. And I'm going to have a sip of water.
I will have some hydrated water with whatever these things are, the salts and stuff. So
cheers to you.
Cheers.